Hi everyone, in this video management relies heavily on marginal costing when making short-term decisions regarding cost. It only considered variable cost which fluctuation with production level various fixed cost. By separating cost into variable and fixed compounds, marginal costing helps manager understand contribute. The main points related to the overview of marginal cost are introduction, key features of marginal costing, CVP analysis, example equation, practical application for business, and conclusion is main factors. Marginal costing is a method of costing where only variable costs are included in a cost of a product. Marginal costing advantages of a simple and easy to understand, useful for profit planning, and helps management in decision making. And marginal costing key features are useful for short-term decision making. Only variable costs are changed to product in mainly focus.
I am Danu Sangavi, key features of marginal costing. The first one, marginal costing is a costing technique in which only variable costs are included in the cost of a product. The next, costs that change with production like materials and labor are considered while fixed costs such as rent and salaries are treated as period costs and charged directly to the profit and loss account. The next, the key concept in marginal costing is contribution, which is calculated as sales minus variable cost. This contribution helps to cover fixed cost and generate profit. The next, marginal costing is mainly used for short term decision making, such as pricing decisions, choosing the best product mix, and concepting special orders. The last one, under this method, closing stock is valued at variable cost only. Thank you. I am Dan Sangavi. Cost volume profit analysis or CVP analysis. Cost volume profit or CVP analysis is a financial rule used to study the relationship between cost, sales volume, selling price, and profit. It helps management understand how change in sales volume or cost will affect the profit of the business. CVP analysis mainly focus on fixed cost, variable cost, contribution, and break even point. Using CVP analysis, management can decide the right selling price, the required level of production, and the best product mix. It is especially useful for planning and short term decision making. CVP analysis helps business control cost, plan profits, and improve overall performance. Thank you.
Let's talk about element of CVP analysis. This slide introduced cost volume profit analysis, which explain how cost, sales volume and profit are related. It helps management in planning, decision making and profit forecasting. Marginal cost equation shows the relationship between sales, variable cost, fixed cost and profit. Contribution. The difference between sales variable cost, it contributes toward fixed cost and profit. Profit volume ratio. Measure the contribution earned per unit of sales and indicate Profit potential. Break even point. The level of sales at which total cost equal total sales and there is no profit or loss. Margin of safety. The excess of actual or budget sales over the break even sales, showing business risk. Key elements and formulas. This slide explains the main components of CVP analysis and their formulas. Marginal cost. Total sales minus variable cost and fixed cost. Contribution. The amount remaining after variable costs are deducted from sales, used to cover fixed and profit. Profit volume ratio shows the relationship between contribution and sales expressed as percentage. Income statement of marginal costing. First, sales. Total revenue from goods and service sold. 2. Less variable cost. Costs that change with production. Example, raw materials, direct labor. 3. Contribution. These show how much is left to cover fixed cost and profit. 4. Less fixed cost. Costs that remain constant regardless of output. Example, rent, salaries. Profit, EBIT, earning before interest and tax. Final profit before tax and interest. Example given. Selling price per unit 100 rupees. Unit sold 1000. Variable cost per unit 60 rupees. Fixed cost 25,000 rupees. Income statement. Sales revenue 1000 unit multiple 100 rupees equal 100,000 rupees. Variable cost 1000 unit multiple 60 rupees equal 60,000 rupees. Contribution margin. Sales minus variable cost equal 100,000 minus 60,000 equal 40,000 rupees. Less fixed cost 25,000 rupees. Net profit. Contribution minus fixed cost 40,000 minus 25,000 equal 14,000 rupees.
Let's have a look at this question from Alpha Manufacturing Company. So here's what we know. Current sales volume is 8,000 unit. Selling price per unit is $250. Variable cost per unit is $100. Total fixed costs are $900,000. Using the principle of marginal costing and CVP analysis, calculate the following: 1. Contribution per unit. 2. Profit volume ratio. 3. Break-even point and in sales dollars. 4. Margin of safety and as a percentage of current sales. 5. Target profit analysis. If company want to achieve a target profit of 300,000, how many units must they sell? First up is the contribution per unit. Here's the formula. Selling price minus variable cost equals contribution. So $250 minus $100 equals $150. Now let's find the profit volume ratio. Here's the formula. Contribution divided by selling price then multiplied by 100. So 150 divided by 250 then multiplied by 100 gives us 60%. Now let's find the break-even point. In unit, the formula is fixed cost divided by contribution per unit. So $900,000 divided by $150 equals 6,000 unit. In sales dollars, the formula is break-even point unit multiplied by selling price. So 6,000 unit multiplied by $250 gives us $1,500,000. Now let's find margin of safety. Margin of safety, the formula is current sales volume minus break-even point unit. So 8,000 unit minus 6,000 unit equals 2,000 unit. Margin of safety as a percentage of sales, the formula is the margin of safety units divided by actual sales volumes then multiplied by 100. So 2000 divided by 8000 then multiplied by 100 gives us 25%. Finally, let's find out how many units the company needs to sell to earn a target of $300,000. Here's the formula. Added the fixed cost to the target profit, then divided by the contribution per unit. So, added $900,000 to the $300,000, then divided by the $150 gives us $8,000. Conclusion. To achieve a profit of $300,000, Alpha Manufacturing must sell 8,000 units.
Now let's talk about practical application of marginal costing in business. We will discuss this main topic under the subtopics of pricing decisions during low demand, accepting special orders, and make or buy decisions. First one is pricing decisions during low demand. A bakery producing buns usually sells buns at 50 rupees each. During slow demand days, they reduce price to 35 rupees. Their marginal cost per bun is 20 rupees. Even at 35 rupees, bakery earns 50 rupees contribution per bun. Here the contribution is calculated by the variable cost must be subtracted from the selling price. That is 50 rupees subtract 35 rupees. As a application here, marginal costing helps justify selling at lower price to maintain contribution and cover fixed. Second subtopic is discuss about accepting special orders. A biscuit factory has idle capacity. A supermarket asks for 50,000 biscuit packs at a discounted price. The regular selling price is 45 rupees. The marginal cost is 25 rupees. The offering price is 45 rupees and the contribution is 20 rupees per special order pack. This company accepts order because it adds extra profit without increasing fixed cost. As a application here, marginal costing help evaluate special bulk orders. Third subtopic is make or buy decisions. A garment factory that produces buttons for shirt has a marginal cost of producing one button of 2 rupees. An outside supplier provides the button for 3.50 rupees. This company continues making buttons in-house because marginal cost is cheaper. As a application here, marginal costing helps decide self-production. This is the final part of our presentation. In a conclusion, covering all parts. Marginal costing is an important managerial accounting technique that helps management make effective short-term decisions. It focuses on variable cost and contribution, which helps in profit planning, pricing decisions, cost control, and break-even analysis. Although it does not consider fixed cost for long-term planning, marginal costing is very useful when used along with other costing methods to improve overall business decision making. So thank you all of you to watching our presentation.